Very good morning. You're watching India Market Open, and happy International Yoga Day to everyone who wakes up bright and early and does their poses.
The jacket doesn't allow me to do that.
Yeah.
Which is,
You got saved.
I got saved.
By the jacket. But no, to all of those poses that the market is doing, and that's the one we track, very flexible as well, and all sorts of contortions that we have been seeing on the markets the last couple of days have been pretty exciting. You
bet, Tamanna. But yeah, I mean, it's a great thing that yoga has gotten so much of prominence in the recent years, because it's a fabulous form of well-being. I mean, you call it exercise, you call it what have you, but it's a great form of well-being. And people who, I mean, there are various people in the market, by the way, who practice yoga, and they say that yoga and meditation has changed their lives for the better, from health perspective, from an investing perspective as well. So
you're preaching to the choir, absolutely. No, doubt about it. And we heard from Prime Minister Modi also about how India's soft power has also, gotten that boost because of yoga, and the world has adopted it as well. So, all right, that's about Yoga Day, but let's set you up for the day of trade today, and I hope, all your positions in the market as your yoga poses are positive today. Global cues are sort of mixed, so nothing great to write home about. And we'll start off with that. The Dow about 300 points up, but that's an outlier if you look at how the rest of the market on Wall Street has performed. The S&P hit 5,500 briefly before retreating. Nasdaq was down nearly 1%. And Dow futures also now, mildly in the red. Bond yields have been rising, have been ticking up, but not a spurt, I would say. They've been ticking up on the back of economic data. The US 10-year was at about 4.26%. And the reason is a slew of data, but among them prominently, I would talk about the jobless claims for the last week that came in. They've fallen 5,000 to 2.38 lakh, but the estimate was a little lower, 2.35 lakh. So net, the takeaway from that is that the employment market is still firm. That is not really giving cues for the Fed to cut rates anytime soon. So hence you see that tick up in bond prices. Brent as well under pressure because of the interest rate outlook. So at about $85 per barrel, actually a little above that. And Asian markets have mostly opened lower. Let me pull that up. So Asian markets have mostly opened low, apart from the Nikkei, because Japan's headline inflation was slightly better than expected at 2.8% for the month of April, but everything else in the red. Let's put up the implied open for our markets, and you're perhaps seeing another day of a bit of consolidation. And you've seen that range for the last few days, or most of this curtailed trading week, where you're not seeing too many gyrations on the Nifty and the Sensex. That's showing in fund flows as well, because after all the block deal mania was over, you've seen fund flows coming down significantly. FIs bought about 400 odd crores. DIs have sold 326 crores. So a bit of a breather, a bit of a pause there, I would say. But the other big thing, Niraj, and I know we'll talk about it a little more in detail, but I just wanted to bring it up right on top, is the focus on Accenture. So we're heralding, in that sense, the result season once again, and we always start by looking at Accenture and what it's saying on Indian IT. The fact is that they have lowered their guidance. They have lowered their guidance. Their revenue outlook has narrowed, and no, I would say, great positive cues for your Indian IT majors coming from the largest, IT company in the world.
Yeah, except for the fact that the stock ended up 7% because of comments on AI. So that was actually a great thing, because they won some large generative AI deals. But yeah, it's something that we'll certainly keep an eye out for and talk about it. I mean, about the implications of this. So, it's a special editor's cut, because at one end we will talk about IT and what Accenture's results mean. At the other end, we'll talk to somebody who will talk to us about fertilizers, and that pack is on steroids. So quite frankly, quite amazing what's happening there. But first, a quick trade setup. So the options data seems to suggest an immediate range of 23,400 to 23,700 within a broad range of nearly, if you look at the larger options piece, you see 23,200 as being that key support. and 24,000 being a key resistance. So very broad range, but within that, a slightly narrower range seems to be 23,400 to 23,700. That seems to be the near-term trading range as well, based on the build-up that happened per se. As you can see, on the call side, 23,600 is actually a key point of resistance as well, based on current OI existence as well. Banking stocks have had a very good move. In fact, the last 4 days, if you look at the Nifty, it's been shored up predominantly by the bank Nifty. Now, will the banking stocks exhaust their up move? At some point of time, this big swing of a trading up move going in one way could come off as well. So bear that in mind. But most technical experts that we've spoken to, even on the show yesterday, we spoke to Axis Securities, and all of them seem to believe that this up move still has some legs to go. So if you are a positional trader looking at what technical charts are indicating, maybe, just maybe, that up move has some legs to go. And frankly, in terms of the other sectors to watch out for, the one space aside of fertilizers which has stood out, and a lot of it also has to do with the fact that there is some hypothesis being laid out for fertilizer companies. It happens ahead of budget every year. But aside of fertilizers, the one pocket that stood out was and real estate was chemical stocks. The first concerted up move that we saw in chemical stocks in trade yesterday, and very likely that this doesn't die out, because frankly, if you look at chemicals, there is no connection to the budget. It is purely going up because channel inventories globally in select pockets have come off, as a result of which companies might have pricing power. So you saw an Aarti Industries, a Deepak Nitrite, a Naveen Fluorine. Deepak Fertilizer has a chemical component to itself as well, and look at what's happened to ammonia pricing. So a lot of those stocks had a big concerted up move in trade yesterday. Very likely that doesn't just end in a whiff, because pricing, if it comes back, is coming back to the chemical space after a really long time. It'll be lovely to talk to a chemical company or two, and we are covering one of the conferences today, where we'll probably try and get a conversation in with one of the chemical companies as well.
Yeah, I'm just wondering on chemicals, Niraj, if the basic concerns have actually ebbed. I understand that in a rotational play, a market is always looking for new sectors, but there are basic, very fundamental concerns about dumping from China. Has that truly ebbed as the Chinese economy also begins to rebound? I'm not sure if all the sort of headwinds have cleared.
Yeah, but actually if the Chinese economy does rebound, then the dumping issue kind of goes away, because they'll need some of those chemicals there too. But your point is well taken. It's a very volatile space in just that because some of the companies which are importing chemicals largely from China in the earlier era, and now that growth, if it comes back in EU and US, might start importing from other nations, not just India, but the other Southeast Asian nations. And there the spec chem companies might get power. So, which is why maybe a Tata Chemicals may not, but maybe an Aarti Industries, maybe a Vinati Organics, and all of those could. So, could be an interesting play.
Yeah. And remember, the market is hunting for newer ideas.
Yeah.
So, I think that's the biggest push more than anything else. All right. We've spoken about Accenture. We'll have a more detailed chat about that. Indian IT companies, by extension, could be something that is on your radar today, because, I think it's going to come down to which Indian IT companies really are moving ahead on generative AI, and that has been the big trigger for Accenture as well. So it's sort of a herald for what we can expect from results season. Keep an eye on IT stocks. Let me talk about another set of stocks that should be on your radar, and that's the insurance pack. And this is an important story. IRDAI has issued a master circular on ULIPs, saying that unit-linked products should not be advertised as investment products. Advertisement of linked insurance products shall disclose risk factors. Now, why are we talking about this? This is quite a controversial kind of an investment that insurance companies have been pushing for the longest time. Remember, insurance companies' job is to insure, and they're not an investment vehicle, but there are, concerns about mis-selling to a lot of people who don't understand that difference and end up buying products of insurance plus investment. ULIPs is one kind of that. Now, what are the stocks that could be impacted if the regulator wants to come down on insurance companies? And remember, the insurance regulator has been very, very active in recent times. So, one is HDFC Life. You should look at SBI Life, and this is, my colleague Puneet has pulled this out. SBI Life might be hit the most out of all because 36% of their new business premium is coming from ULIPs. For Max, it's 35%, and for HDFC Life, it's 15%. LIC does not give a clear breakup of how much of their new business comes from a ULIP-like product, but I would keep an eye on LIC as well. So for insurance companies, another bit of regulatory hurdle could play out today. Apart from that, not a very good news day for companies. So JM Financial is the other one. Remember, they were already under SEBI strictures. Those are going to continue. So SEBI has made it clear that they will have restrictions on acting as lead manager for all public debt issues till 31st March 2025. So that pain point gets extended. JM Financial was actually about 6% up yesterday. So you might see a negative sentimental impact there on the stock, at least immediately. So unlike an IIFL, whose woes seem to have eased, JM Financial is definitely not in that category as of now. I'd watch out for that. Amara Raja is the other one because Auto Ank is in vogue this entire week. The Auto Ank space has been, really up and about. Amara Raja, remember, earlier in the month was also in focus because TDP is now part of the central government, and Amara Raja's management, is linked to the TDP. In fact, Jaydev Galla was a member of parliament for the TDP party as well. But anyway, the news today is that the company is investing 20 million euro to increase its stake in a battery tech company, a European battery tech company called Inamdar. The investment includes subscription to an additional 4.5% equity stake. So they're increasing their stake. Their total stake now goes up to 9.32. Now, why Inamdar is interesting. It specializes in R&D and production of batteries for custom-designed EVs. And they're setting up, this was important, one of India's largest gigafactories for Li-ion cell and battery pack manufacturing. So I reckon any company which is getting ahead on the curve on EVs, semiconductors, technology is one to watch out for. So in that sense, I would put Amara Raja on your radar this morning.
Yeah, most certainly. And Amara Raja, viewers, has had a fabulous run. If you look at Amara Raja's price movement in the last 1 year, the stock is at 1400, was at 700 less than a year ago. So in 12 months, it's 118% uptick, less than 700 actually, from the looks of it, right? 118% uptick. So it's a stock which was very cheap, has moved up a little bit. There was also this whole TDP angle attached to it. So there was a bit of a spurt that came in post the election verdict, and now they're talking about newer technologies as well. So pretty interesting what's happening with Amara Raja. Watch out for that stock today. Watch out for Aster DM. There is a block deal by Olympus Capital Asia today. Now, this is interesting and important, viewers. Just hear me out. So the price is at a 7% discount, which is fine. But the size of the deal is 2.5 crores with an option to go it up to 5 crore shares. Now, why is this important? Because if they indeed do a 5 crore share sale, which is about 10% stake of the company, then it becomes a clean out trade. This is the stake that Olympus Capital has. So if they indeed take it up to 5 crore shares, then it becomes a clean out trade, and that might actually help the stock as well, because the overhang of supply goes away. If they do not do 5 crore shares, then the overhang of another 5 crore shares coming up will stay until that happens. So keep that in mind. Aster comes in at a discount of 7% as well. So it's not, clearly looking at the demand, you just look at what Sansera did, 0 to 5% range of a discount. So they clearly knew their book and the demand that was likely to come in. In Aster's case, they're pricing it 7%. So not a 10% discount, but a 7% discount nevertheless. Watch out for this one, and watch out for the size of the deal in particular as far as Aster DM goes. Then DMart could be interesting because NDTV Rajasthan has covered this piece of news extensively, and I urge you to go and look it up, if not on the channel of NDTV Rajasthan on the social media handles. But apparently duplicate products have been found in a Jaipur store at D-Mart. Now, this might maybe bring about an impact on the stock. See, it's as of now, as we understand, it's a concentrated issue in one store, but whether it's enough to bring a trusted brand stock down today remains to be seen. I would watch out for this one. That's the key thing. Remember, it's a bigger story than just the stock, by the way. But from our perspective, pre-morning, you've got to set up what means for the markets and therefore laying it out that it could have an impact on the stock as well. Remember, it's a bigger story, and we'll pursue this in detail later on as well. And before we get to brokerage notes, a couple of block deals which were interesting. That's the third set of stocks on my radar. Hobak Colorants, Quant Mutual Fund has bought 1.2 lakh shares at 453 apiece. So watch out for this one. The stock was up and about in trade yesterday. You know, these days, anything that gets attached to the name Quant really has a bit of a buzz. This used to happen way back when everything attached to Equity Intelligence and Paulin Juvelia used to move up. Then some other funds have enjoyed that. Sunil Singhania and Madhu Kela have enjoyed that. HDFC has enjoyed that. Quant currently is in the thick of things. Anything attached to the name Quant tends to move up us. By the way, speaking of Equity Intelligence, yesterday Indiabulls Real Estate was up and active, and that's the other stock wherein one BofA Securities has bought about 34 lakh shares, so this must be a P-note trade, and Equity Intelligence India has bought 33 lakh shares, which is about 0.6% stake at 151 apiece. So this too was the other one that went up in trade. Watch out for this one in the session today as well.
Just talking about the D-Mart story and the spurious oil coming, and you're right, Niraj, this is a bigger story, and this is something we've been tracking. I mean, what we're eating and the quality of what we're eating is just an appalling scare, and we've been covering it on all our social media handles as well. From animals being found in products to spurious oil. So there is a bigger story that we need to look at, and manufacturing companies of food products really need to tighten their belt. But I just want to talk about one more company before we get to the editor's cut and our special focus on Accenture and fertilizers, and that is Suzlon. Now remember, Suzlon and both Inox Wind had a pretty good uptake yesterday, and some of that reason partly was because of the cabinet decision to provide funding for two major wind energy projects off the shores of Tamil Nadu and Gujarat. Now, it's not clear at all if Suzlon or Inox will participate, but interestingly, there's a Morgan Stanley note out, and they're talking about their visit to the Suzlon Energy's Daman plant and what they see after that. So they've maintained an overweight, set a target price of 58.5. So that's about a 16% upside. They say the plant production capacity is at 2.5 gigawatts of turbines per year. And nacelle and hubs form 65% of the cost of equipment. The wind project cost is in the range of 7.5 to 8 crores per megawatt. And there is potential to expand production by utilizing warehouse space. It also now caters to domestic markets versus exports earlier. So I think Suzlon might see a bit more of a tailwind today more than anything else. So yeah, green energy, electric vehicle, I think those are the broader themes that the market needs to be looking at.
As a result of which wire stocks come into focus as well. Anything related to green energy, this thing, power transmission is also doing well. Yeah. But the Goldman note on wire has some other reasons, which is why I led into it this way. But they are saying that the rally in base copper prices are driving a revenue uptake. You know, copper an integral part of any electrification project, by say, and because copper demand is so strong, so copper prices move up, as a result of which their revenue moves up. It's very simple for some of these companies. So Goldman Sachs has increased Polycab's EPS estimate by 12%, 12% and 7% over FY25 to 27. The target price on Polycab is at 7,100 versus 6,360 earlier. They are neutral on KEI. But the target price has been hiked there too, 3,690 versus 3,330 earlier. And one more brokerage note. There is also a Nuama on Bikaji, by the way, where there's a 23% upside. But the other brokerage note that I have is this Jefferies note. Model portfolio changes. They've reduced consumer staples weight to neutral. They've added overweight to industrials. Everybody's thinking of how you might want to go long on FMCG. Jefferies is doing the opposite. They've removed Marico from the model portfolio, and they have added weight of 1 percentage point each to GMR Airports and Larsen & Toubro. So watch out for both of these as well. Okay, now time for Editor's Cut. And Alex, you will have me and Tamanna as your co-hosts today, but two important topics.
Absolutely. And, I love the conversation that you had earlier, several of them actually, but then most importantly, what you were saying about yoga and the importance of yoga in our lives. I must confess that I know people who practice this much more than I do, but whenever I have tried it, there has been some benefit. Have you tried cat-cow and camel pose and sun salutation and all of the other things that we're talking about?
I've tried the easier ones, I must say. The difficult ones, which require a lot of core strength and balance, they escape me sometimes.
Yeah, okay, all right. So, but let's get to the crux of the issue. And there are two aspects that we're discussing today. One has to do, of course, with the fertilizer stocks, but the other has to do with what the IT stocks will do in trade today, and that is on the back of what Accenture said yesterday. Of course, as Niraj pointed out on the show, and Tamanna also, that Accenture was up 7% yesterday. But perhaps you should not read too much into that, because the guidance does not look too good. Narrowing of the guidance, guys, what does that mean for IT companies?
Yeah, so it's interesting. I mean, so just the news, just to put numbers there, the full year revenue growth, and remember they follow an odd September to August year, but the full year revenue growth in the range of 1.5 to 2.5% versus earlier 1 to 3%. So the lower end has been hiked, upper end has been brought down, tighter, and you expect that as you come close to the year. But what actually happened, other than that, and because of which I think the stock went up, was that Accenture said that it had more than $900 million in generative AI bookings. I think this was the key thing, and which is why the stock went up. Now, what are the key takeaways from all that Accenture has said? One, that discretionary spends continue to remain under pressure. And that is what the larger impact on Indian IT is, because Indian IT hasn't quite reached generative AI bookings the way Accenture has. There is commentary, there aren't that many kind of bookings happening in Indian IT per se, to the tune that Accenture has managed to do it. So discretionary IT spends under pressure, limited change in demand environment. The first point that you can take away from Accenture's commentary. Financial services and CMT vertical under pressure in key markets. And therefore, the whole barrage of stocks like a Tech Mahindra. Sorry?
BFSI, the ones that are focused on BFSI.
Exactly. So you think of Wipro, you think of a Tech Mahindra, you think of possibly even a TCS, all of these come under pressure, right, in that sense. So that is part two. And part three, like we said, it's traction on Gen AI. So if you show the right product and the right capabilities, then maybe Gen AI spends are happening. Now, it may not happen on the large cap IT names. Clearly, they aren't as nimble, with reason maybe, because there is legacy business to take care of. But as Sandeep Kalra and Sanjay Jalona told us in that show to us, that maybe the newer and the smaller companies and product companies which are actually developing some AI-based products might actually find bookings. So maybe, just maybe, guys, in the commentary that comes at the end of Q1, we might hear about Gen AI from some of the smaller companies, which might have a larger impact on their overall numbers, and those stocks might actually be okay.
So just to add to that part, Niraj, at least from what the commentary has been thus far, and of course we'll wait for what they say in their numbers, the Indian IT majors are utilizing AI as an add-on to their existing services and clients, rather than coming up with something brand new. And that, I don't know how far it will get you in such a competitive thing. And if you look at what Nomura is saying today, they're saying reduce TCS, Wipro, LTI, Mindtree, LTTS and Emphasis on the back of this. They have a buy on Cognizant, TechM, Coforge, Birlasoft and eClerx.
That's interesting.
So to the point that the smaller ones who are more nimble could move ahead. But I mean, what's to say that the giants who are really entrenched are not going to come up with a surprise? So that's going to be exciting to see.
Hopefully they do.
They would have, so the question is not about when they will have to turn, but it's like a truck turning versus a car turning, right? How long does it, or a ship turning? It takes much longer.
As that series, I'm forgetting the name, Succession said, right? I'm in the middle of turning a XXX tanker.
Okay.
But just one quick point, sorry. Just lastly, the valuations.
Right? I was going to come to that.
Okay, sorry. Okay.
So, but then this is not something that is different, Niraj. The point, it's not different from what people have been saying for the last several months, is that large cap IT don't look at as closely as you should be looking at the mid cap and the small cap companies, and that is reflective in the valuations.
Yeah, because Nifty IT valuations, weightage of large cap IT very high, 26 to 28 times. Premium to Nifty, premium to averages. Why preempt until they show something and then go out and buy it? It's okay to buy it 5% higher if they show the traction.
Okay. So that's the point on IT. But there's also a group of stocks has been doing incredibly well, and that is, of course, the fertilizer pack. And there are several theories about why these companies are rallying very suddenly. Of course, we have news about the MSP, but there's also buzz about GST. What's going on, Tamanna?
So the reason that there is buzz about GST is that the Fitment Committee has actually recommended that you rationalize GST on fertilizers. But now the buzz in the market and what the stocks have been running up on, Alex, is that fertilizers will be completely exempt from GST.
Right.
That is a bit of a stretch, because the same Fitment Committee says that if you do that, you will mess up the inverted duty structure. So that is one. The second is, of course, MSP. Remember, the MSP hike is not that much. It's quite decent compared to what could have been expected or could have been seen as a populist move. But nevertheless, you're putting 2 lakh crore rupees in the hands of farmers. You are incentivizing them to go and produce the crops on which MSP have hiked, and they will need fertilizers to do it. So it's fairly 2 plus 2 is 4 in that sense. The question is that the kind of run-up, is it justified? And in fact, we have Prateek Tholia joining us now. He's Senior VP Institutional Equity Research at Systematics Group on this very topic. Prateek, very good morning and great to have you on Editor's Cut today. And let's talk about all things fertilizers. The kind of run-up we've seen in the last 3 or 4 days. Reasons being ascribed are the GST meet, which will take place on Saturday, maybe the MSP hike, perhaps more to come in the budget. Keen to know what your reading is.
Yeah, hi, good morning. Broadly, we are also hearing similar things. So I think the whole sector, the run-up that you've seen over the last 2 days is, of course, like you just mentioned on GST. But again, that would be a little far-fetched, because 5% GST, from farmer perspective, it's not going to make too much of an impact on the way he buys fertilizers. It's anyway is pretty subsidized. So, but that is the chatter that's happening on the street. And of course, I think on the subsidy bit also, with the upcoming budget, we are expecting the subsidies to improve. So they had cut the subsidies in the interim budget, but that was not what it should have been, because the costs have started to move up. The prices of key raw materials have started to go up. So to that extent, I think the government will adjust for subsidies as well. And therefore, the profitability should now improve. And that's also one of the reasons why stocks would have started to move up. Of course, MSP has been, while you did mention that, it has been not that high, not very populistic hike. But again, if you see, typically after the election, the next year, immediately after the election, the hike has been in the 3 to 4% range. So this time, I think the average hike is 5 to 6. So to that extent, I think it's very encouraging. Of course, on monsoon also, if you see monsoon, the whole buzz around monsoon is that it will have a La Nina sort of a year, and we'll have much better rainfall. So if you talk to the farmers at the ground level, the sentiment is very positive. At the ground level, farmers are willing to buy more with a higher MSP. They are assured of a good recovery of their cost. Plus, even during the election, we've seen a lot of populistic measures. There are a lot of cash rollouts. There are a lot of things done at the farmer level. So they are already flush with good amount of cash. Plus the crop the Rabi crop which was sold, that was also sold at a price higher than MSP, especially wheat. So farmer has decent amount of cash flow with him, a good monsoon, a higher MSP, and all of those things, which means that the demand for fertilizers will be very strong this year. We are expecting a very strong volume growth. Of course, last year was also weak, so on the back of that also we are expecting a very strong volume growth. The buzz is, in fact, at the retailer level, the dealer level, is that we might actually have a inventory sellout. So whatever inventory is available today, we'll have actually that gets sold out by July, and then we'll have to have a lot of imports also might have to happen. The companies will operate at a much higher capacity utilizations. So I think net everything is looking very positive right now.
So Prateek, if you have a buzz of an inventory sellout by July that companies might have to actually import, what is then the margin outlook for a segment which is quite subsidized and has a lot of focus from government on what prices are being demanded from farmers? And secondly, does it justify the kind of run-up we've seen? Do you see more of that run-up in this segment of stocks?
Yeah, so from margin standpoint, I think margins were pretty weak last year. The subsidies were lower. So like I said, we are expecting a better subsidy payouts this time around. So margins should be better off versus what we've seen last year. Of course, in urea, the margins are pretty much stable. So there's not much of an impact over there. What we are margins when we talk about it's mostly on the complex fertilizer space. And over there, the margins are likely to be better. Also, last year we had a lower production also, so capacity utilizations were also weak. So you'll have operating leverage also coming in this year if everybody is operating full out. So margins should be much better than what we've seen in the previous year, especially for the complex guys. And sorry, I forgot the second question you were asking on the valuations. Yeah, so
Prateek, very simple question. Or bhagenge fertilizer stock?
Yes, absolutely. I think so. What is that right now? The valuations are catching up with their prehistoric levels. I mean, what we've seen in the good monsoon years, but the earnings growth has not yet been factored in by most of the analysts. So when we're talking about total sellout of inventory, we are talking about a steep earnings improvement also coming over here. So we expect better earnings growth, and so the valuations will remain higher at least for this season for the fertilizer space.
Hey Prateek, so quick question on your picks and what you like in the space, because we've seen stocks, RCF run up 35%, NFL up 35% also, Chambal up 31%, Deepak up 21%. Have any of your targets been hit, or have you revised them upwards? What are your buy calls?
So we have buy on Coromandel and Chambal. Both have actually run up quite significantly in the past few weeks. So we have to now. So the valuations are now pretty stretched, like I said, but we still have to factor in the earnings growth. So what we start the year with a moderate sort of growth, considering that we'll have a decent sort of monsoon. But this year it's looking pretty good. So we are in the process of upgrading our volume numbers higher, and also therefore the margins and subsequently the earnings growth.
But if you are in the process of upgrading those volume numbers, is there a range that you think that it could come go up by?
Yeah, so typically for fertilizers, volumes, if you see in a average year, we factor in a 3 to 4% sort of a growth. But this year we are expecting a sellout, so we will have a high single digit sort of volume number. So somewhere around 8-9% volume growth we are expecting.
Prateek, wanted to check how you're seeing the input costs for fertilizers. Have they relatively eased off? What is the outlook there?
So input costs had moderated in the fourth quarter, but now we are seeing ammonia prices have started to move up. Urea also we're expecting there are some shutdowns in China. Brazil also the consumption has been good, so we are not expecting a surplus sort of urea in the market. So prices of urea should also move up. Similar is the case with some of the other complex fertilizers. So we are expecting that prices could firm up, and of course globally also most of the producers are always dependent on India because we are one of the largest importers of fertilizer. So when the Indian market starts purchasing, then the prices start typically going up. So third and fourth quarter is our leaner periods for us. That's when the prices also cool down, and the first and second quarters when we are and this year because of good monsoon also we'll be consuming more fertilizer. So we are expecting the raw material prices to actually inch up.
Prateek, one final question from my end. What is the risk to this? What is the key risk to this rally? What will make you change your optimism?
Monsoons.
Monsoon. That's the only thing. Okay. So if the monsoon is good, then Prateek, systematics would remain constructive, I presume, on fertilizers.
Yes. Absolutely.
Okay.
Absolutely.
Good to know that. Okay.
All right. So there you go. We did a social piece right at the start, before the start of the monsoon, explaining what the little boy and the little girl means, La Nina and El Nino. And this time, I think this season is for La Nina to be up front and
benefiting. You still have a deficit as of now.
But that will pick up.
But that will pick up, and also how that monsoon is, the
spatial distribution
is spaced out is important. But anyway, let's hope for the best and bounty from the rain gods.
Absolutely. On that very promising note,
of course,
an optimistic note, let us slip into a very quick break and set you up for the more near term, which is what happens in just about half an hour. And we've got FNOQs lined up for you, so do stay tuned.
Welcome back. This is India Market Open. We are taking stock of the futures and options space. It was a quiet expiry, the weekly option expiry of the Nifty yesterday. But, in fact, we didn't really see too much traction when it comes to futures space either. If you consider just the Nifty 50 at the moment, where what we are keeping an eye on is the benchmark. Again, marginal moves and very little to change as far as the Nifty futures open interest is concerned. The Bank Nifty futures, again, the picture wasn't very different, even though that outperformed the Nifty 50. A lot of short covering coming through to a certain extent. Of course, as we move into a new week, we are watching out for new levels. Yesterday was a day of trade where we did see a lot of writing around the 23,600 calls as well as puts. But even in terms of your overall open interest distribution picture, we continue to keep an eye on the 24,000 call mark as far as the Nifty is concerned. On the lower end, again, watching out for 23,200, 23,300, and 400 levels as far as puts open interest is concerned. As we move into the new week, there are several stocks that we need to keep an eye on as well. A lot of them buzzing in the agrochemical space. In fact, we had GNFC and Coromandel International looking at fresh longs coming through, besides Tata Chemicals, of course. And even among stocks which saw unwinding. Well, we did see Chambal Fertilizer, which advanced by as much as 19% yesterday. And besides that, we had India Cement, Bandhan Bank, ICICI Bank, and Indus Tower looking at a bout of short covering. But let's take this forward and take a look at what we can expect in the markets and how we in fact can use options to perhaps go ahead and trade here. Well, we have Amit Goel of Amit Ventures who's joining us on the show. Amit, morning. Thank you so much for joining in. I know that you actually have two specific strategies on the Bank Nifty, and this is under two different circumstances. But let's start with your overall view on the Nifty and the Bank Nifty. Maybe we can talk about the Bank Nifty later on. Just your view on the Nifty going forward at the moment.
Hi, good morning, Agam, and good morning to all your viewers. Thank you for having me here. We've had a stellar rally in Nifty right from the exit poll days. We have had a very sharp recovery, and right now we are at the top of a trending channel. And the near-term support in Nifty happens to be 23,300 and 400 levels, with a fair bit of put writing over there. Since we are at the top of the channel, I'm a little skeptical in terms of initiating fresh longs, simply because we have noticed since last December, in the last 6 months of trading sessions, every time the Nifty tries to breach the upper channel, it has faced some resistance, and we have come back to the middle of the channel, which is at 23,000. So any bit of fresh longs to be created here will require some bit of confidence in terms of the price action, which I do not see really happening anytime soon. So probably we are in a bout of some sort of consolidation in the overall markets. Speaking about some of the sectors which are in focus, obviously we have all seen fertilizers, sugar, all the budget sensitive sectors seeing a lot of traction on account of positive news flows and speculation. One small advice for all the investors, all the traders specifically, some of these stocks do happen to be in the F&O space and have seen very sharp run-up and some sort of short covering rallies as well. One would probably be a little cautious here in building fresh longs, simply because after such a sharp rally, if there is some sort of correction, which is par for the course in terms of profit booking, any fresh long created here would probably end up in a loss. So be a little cautious in the market is the mantra going forward.
Sure. Right, Amit. So let's talk about the Bank Nifty now. You have two different structures under different circumstances. I reckon that at this point in time, the 52,000 mark becomes important. Can you take us through that first structure that you're talking about here?
Sure. So Bank Nifty has uncharacteristically acted out of the way. While Nifty has been consolidating, Bank Nifty said, okay, I'm going to shoot up to the moon. We have had some spectacular rally in Bank Nifty. We have seen some sharp short covering rally with the 51,000 calls getting covered during the last two trading sessions. The question now is whether this rally will continue or not. The answer, in my opinion, lies in the 52,000 call OI, which currently is offering some sort of resistance along with the confluence of the daily super trend falling around that level. So the way I would want to play this is in two parts. It's a conditional bullish view. Suppose we break the 52,000 mark and we continue to trend there, and we witness some sharp, covering of calls and writing of puts at 52,000 levels. This would give me confidence to build fresh longs. So it's a conditional bullish view. Here, if we see this happening, we can initiate a bull call spread, a simple bull call spread for the next expiry, wherein we buy the 52,000 call and we sell the 52,300 call, one lot each of the 26th June expiry. The max debit is estimated to be about 2,000 rupees per lot, giving us a potential profit of about 4,000 in this trade. This is the bullish view. Now, speaking about the not so bullish view. If we witness some sort of selling pressure, like we have seen in Nifty in the last three trading sessions, that we open with a gap up.
Let me just stop you there. If you could just take a moment before we move on to your other strategy. I want to very quickly revisit what you have just mentioned. And this is, of course, under the conditions that you see the Bank Nifty move about the 52,000 mark and will sustain there under those circumstances. If you actually start witnessing a covering of calls and more writing of puts around there, that's when you in fact go ahead and place that bull call spread. Again, as far as your risk reward ratio is concerned, if we can quickly revisit that as well, if I can have those graphics back on screen, it actually is a very favorable one considering the kind of traction that we've seen. So it's 4,000 per lot, and of course we could potentially see a big up move there as well. And considering the margin required is about 25,000 rupees, again, it does seem like something which is very positive with respect to your overall returns. But yes, Amit, you were telling me about the other aspect when in terms of if there could be some bullishness under that circumstance, what are you doing?
Yeah, so the way I'm looking at it, since we are also outside the trending channel in Bank Nifty as well, so I'm a little skeptical about the rally continuing conditionally if the call writing does not unwind. Now, the second way I would like to play this trade is, there is no harm in waiting for the data to come out before we set up a trade in the morning. So if we witness some sort of selling pressure or some sort of profit booking in Bank Nifty, which is par for the course after such a stupendous rally, and we see the 52,000 call OI instead of unwinding, getting added on during the day, we could probably consider the 52,000 mark as a near-term technical resistance. I'm not saying I'm becoming bearish. I'm just saying that it could become a technical resistance in the near term. And in order to capture this sideways expected movement, we could initiate a simple iron condor for the next week, wherein we sell the 52,500 call and we also initiate a sell on the 51,000 put, one lot each of the 26th of June expiry. We will also buy the hedges of a 52,800 call and 50,700 put. This will yield us a maximum profit of about just 1,500 rupees, since we are covering on both the sides by buying hedges. The max theoretical debit on this trade is 3,000 rupees with a margin of 34,000. Since the max debit in an iron condor is theoretically always greater than the max profit, we will initiate a rupee stop loss here of 1:1, keeping the max stop loss at 1,500 rupees per lot.
Okay. All right. But now, of course, the advantage of deploying an iron condor, that is, buying wings outside the strikes that you have sold, is that your losses remain limited. And even after that, Amit has actually provided you with a rupee stop loss so that your risk to reward ratio doesn't move beyond 1:1. Of course, that is under the circumstance that you do not see as much bullishness in the Bank Nifty, and the crucial level, of course, once again, even in this strategy, is to watch out for the 52,000 mark. That's what you have as far as the Bank Nifty is concerned. Two very sought out strategies as far under two different circumstances on the Bank Nifty. Well, on that note, Amit, going to take a moment to thank you for joining us and taking us through your views, and also actually providing two different options under two different circumstances. It's not something that we come across very often, but this certainly will be most appreciated by our viewers who are interested in trading the options market. With that, it's back to you.
All right, thank you for that, Agam. And let's get on our next set of experts. Kush Bora, founder kushbora.com, with us this morning. Aditya Shah, founder Hercules Advisors, also joining in. Happy Yoga Day to both of you, if you practice. But we're talking about a different set of movements and positions in the markets today. So let's start with that. Kush, let's start with what kind of flexibility you see on the indices.
Hi, Tamanna. First of all, very good morning to you and everyone on the panel. Well, the flexibility only seems to be coming in for the Bank Nifty, right? Nifty is very rigid, doesn't really want to go anywhere, probably going into the Shavasana mode. But other than that, yeah, I know you've been saying that, I like to have that I told you so moment. This time it wasn't to be. Last week when we spoke, I did say that, perhaps Nifty could consolidate and, buy on dips is the best strategy. The Nifty is not really inclined to give us that dip. My view actually still remains. I'm not very convinced on going long on Nifty at the current juncture. Any kind of pullback towards 23,300 or 23,000 would be a good entry point. Bank Nifty, however, continues to shine on. For the year-end calendar year, 55,000 is a very realistic target that we have on Bank Nifty. and the participation from private banks is just beginning. But here too, we are approaching slightly overheated territories, at least going by the PCR, which is at 1.25 currently. So any kind of pullback should be taken as a buying opportunity on the Bank Nifty.
Okay, so Bank Nifty is the one working, rest is in Shavasan. Let's get back to your top picks of this morning.
Sure. So finally, the chemical themes, theme seems to be playing out. A lot of companies from this space are starting to, do well. So PI Industries is one stock that I have on my radar. There was a very strong base formation around the 200-day moving average. Yesterday, we saw a very clear breakout with strong volumes. So from the near-term perspective, we are looking at 38.30 and 39.50 as the targets. 36.90 remains as the stop loss. On the other end of the spectrum is Dilip Buildcon, where the stock's actually seen a very stellar run over the last 10-15 sessions, again taking support from the 200-day moving average, but has now gone way above it. There has been volume pickup as well. The momentum indicators are also showing a breakout. So 570 and 595 are the near-term numbers to look at, and 530 is where I would keep my stop loss.
Yep. Well, an infra name featuring and not surprising there with all that's happening out there. Thanks, Kush, for that. Aditya, good morning. Weave you in this conversation as well. When you look at the texture of the market over the last 2 or 3 sessions, needless to say, you can't escape fertilizers and what they are doing, but you can't escape the move that is happening in the larger banks as well. Now, HDFC Bank may have been a great buy at 1450 or thereabouts. It's now at 1670, 1680 thereabouts. ICICI Bank, Kotak, etc. all have moved up. Are you constructive from here on for somebody who's missed the banking rally thus far, fundamentally?
Good morning, Niraj. You remember I've always been constructive on the large private sector banks. The credit cycle has moved up now, and it is time to be very cautious on the PSU banks and the smaller private sector banks. The larger private sector banks have undergone a massive derating. We've seen HDFC Bank trading at about 2 times price to book. We've seen Kotak Bank trading at about 2 times price to book. Similarly, Axis trades at about 2.4 times price to book. With a credit growth of about 15 to 20% for the larger ones, they are gaining market share across loan growth and deposit growth. I think that's my bold call, that the next leg up of the market will come from the larger private sector banks, because there a lot of derating has happened and that needs to get corrected. So I'm still positive. However, that strong up move that we saw in HDFC Bank over the last 2 to 3 days, that will not come about. Now all eyes will be on how the bank turn around in their net interest margin. If the margin starts to improve by the end of this quarter to about 3.7, 3.8%, we could see HDFC Bank touch about 2000. So really very constructive. That side of the market is where there is a little bit of valuation comfort in a very, very aggressive and a very expensive market.
Okay. The other aspect, Aditya, yesterday was the kind of uptick that we saw, concerted uptick in chemical stocks, right? A clutch of them went up with reason, maybe because channel inventories are coming off. Reading the NOAA note and the ISEC note as well. Do you find substance here? Because they've been kind of laying low for the last couple of years now.
Look, Niraj, 2020, 2021 was a top for the intermediate top for the chemical sector. China had gone out, inventories were low in the industry, so all of the stocks had rallied. After that 2 to 3 years, the stocks have done practically nothing. China is back, inventory stuffing was there. Slowly and steadily, this will start to improve. Again, mind you, chemicals is a very, very specific industry where you need to go chemical by chemical and analyze if they are specialty or commodity chemicals, and then from there on take a bet. In my view, as I had also said, chemicals is the place to be over the next 2 to 3 years, because as the demand starts to come back, slowly and steadily, these companies will start to do well. So I'm not surprised that there's a short-term rally. However, over a longer period of time, say 3 to 5 years, these are the stocks to be in. Market overplays some sectors, like right now it is overplaying the defense sector, it is overplaying the PSU sectors. Market underplays some sectors, like it was underplaying the large private sector banks and the chemical space. So all of this is temporary in nature. All of this will get turned around. Patience is the name of the game in the chemical sector. I'm extremely bullish on the sector per se.
Are you as constructive, Aditya? Very good morning, Tamanna here. Are you as constructive on fertilizers as well?
Good morning, Tamanna. Not so much on the fertilizer space as well, because this rally in the fertilizer sector has been spurred on by 2 to 3 things. One of them is that the GST on fertilizer should come down from 5% to 0%. The second point is government has finalized MSPs for certain crops, and that is fueling up the rally on the fertilizer sector. In my opinion, a lot of the rally over the last 2 to 3 days has already been done. I would like to be cautious, and I would like to target the agrochemical companies such as PI Industries or Rallis for that matter, where uh, long-term 15 to 20% growth is still there. So a little bit of cautious on fertilizers. Number one pick will be the chemical space. Number two pick will be the agrochemicals.
Okay, so cautious on fertilizer, agrochemicals would be number two, and of course chemicals you are bullish. Coach, just wanted to get your take on some of those fertilizer plays. On the charts, are you still seeing a further upside?
Well, from the fact that some of these names, fact RCF, some of these names close at the high point of the day, there could well be, some more momentum that, take these stocks higher. But for now, the rally seems to be done in the sense that, the risk reward ratio will not be favorable. They've gone into slightly deep, overheated territories. So on pullbacks perhaps, but, no fresh entries recommended on some of these names.
And no fresh entries recommended right now. Now, what are the other sectors that could see a buzz today? We'll talk about all of that and the pre-open setup when we're back after this very short break. Stay tuned.
Back with India Market Open right here on NDTV Profit. We've discussed some of the high-flying sectors. Remember, Kush Bora says that do not go out and buy or make an entry into the fertilizer stocks at the current levels. And from a risk-reward perspective, if you're a technical trader, maybe it's good advice. Fundamentally, we heard an analyst from Systematics kind of speak about how he might be constructive on that space, monsoons notwithstanding. So fertilizers done, chemicals done. What's not done is IT. Now, for all of you who've joined in late, here's what's happened. Accenture has lowered its guidance, but has also done generative AI bookings. As a result of which, while the lowering of the guidance aspect could hurt the other IT names, for Accenture, the stock went up because of $900 million worth of generative AI bookings. Now, Kush, I'll come to you first on the technicals for some of the large cap IT names. I'm not including mid cap IT here. The 6 names on the index, do any of them show a trade possibility? Maybe they'll start off lower today. Would you trade them?
So not really, Niraj. I know that perhaps I have missed some of the rally that came about in the IT large cap names. The likes of Wipro and HCL Tech. But a lot of these names still don't give me that kind of comfort that these are out of the woods and you can go out and buy and the momentum's with them. Not really. So I'll be very optimistic, and especially if I'm playing momentum, I don't think IT is the space.
Kush. Yeah. Sorry for intervening. I'm actually asking you the reverse. I'm asking if you'll go down and short them today because they'll start off lower.
Oh, for sure. Then I've got candidates lined up. You've got a Wipro that you can consider perhaps going short on. HCL Tech is close to some of the support zones where 1420 is the 200-day moving average. If it does break that, go ahead and short. So Wipro and HCL Tech are 2 names that I have on my radar. If you want to go short intraday, you can consider both of these.
Okay, so intraday traders, remember, and he's very specific, Kush, looking at the charts and the levels, that Wipro and HCL Tech are the 2 stocks on his radar. Remember, stocks like, actually let Aditya answer that. Aditya, based on Accenture's commentary and particularly slight discretionary spend issues around even BFSI, would the likes of Wipro, maybe a TCS, maybe Emphasis, etc., come under a bit of a cloud?
Niraj, I think that there could be a correction in these stocks, but however, I am not surprised given the fact that now the rate cut expectations in the US have now decreased to only 1, that too by the end of this year. I don't think that markets in the US and the European Union have recovered per se. So my perspective is that these stocks could show a short-term correction. However, for a long-term investor who is willing to spend some 3 to 5 years in the IT sector, I think 25 and 26 could be good years for IT as the US Fed continues to lower down the interest rates. Discretionary spending should come about. So my perspective is short-term pain for IT companies, but for a long-term investor, it is a long-term gain that you can add any of these stocks into your portfolio.
Let's look at the first pre-open rates hitting and what's happening there. And of course, very, very initial trends. But CE Info Systems, let's pull that up. Yesterday's winner is once again opened with a lot of excitement from investors, nearly 12.5%, 13, 14% actually up at this point. Look at Endurance Tech, since we're talking about Auto Ank, and a Citi note out today about their meeting with the management in Singapore. They're very, very optimistic about the potential for Endurance Tech. So that's about 3.5%, 4% up right now. But it's not just that. We were talking about fertilizers a few seconds ago. Look at FACT. Look at in the chemical space, RCF. Look at alkyl amines. All of those pockets once again showing an exciting morning. In fact, I just want to pull up for a second to see how FACT is doing. Again, about 9% up. So fact is a whole different story. Some of those chemical counters also doing very, very well this morning. I'm going to come to your question on CE Info Systems. I mean, it's just dizzying kind of a move last couple of sessions. Is this a profit booking opportunity?
100%. The stock's actually gone into overheated territories yesterday. Today we'll actually just push it further. So again, like we spoke about the fertilizer pack, fresh entries at these levels, and especially after the kind of moves we saw yesterday, opening at significantly higher levels will not make it any bit attractive. So wait for a decline. Anyone who's got should exit partially, if not completely. and hold the positions, hold the remaining positions with a trailing stop loss.
What else is happening? JM Financial about 5% down was expected because of SEBI's communication that no real relief for them at least till March 2025. But your capital market plays are also feeling a bit of heat today. Look at Motilal Oswal, look at Anand Rathi, and that could be in part because of news reports that something is coming on the derivative side. Winter is coming, whether it's taxation. One report claims, and these are only claims right now, that profits from this segment of the market could be taxed like lotteries. I don't know if that will happen or go through, whether there will be a tax change, whether there will be some kind of tweaking in rules, but you might see a bit of pressure there. Nykaa having a very tough day, about 10% down as well. But, Aditya, just quickly wanted to get your view on all of these capital market plays, which have been having a great run-up. Do you think it's time for a breather as far as this is concerned, this pocket is concerned?
So, Tamanna, we've had the regulator, SEBI, cautioning retail investors. We've had the finance minister also expressing concerns that a lot of this rally in the market has been fueled by retail investors speculating in the F&O space, and all the brokers are generating a lot of income through the F&O space. And mind you, this is the regulator's data that a lot of retail investors tend to lose money on F&O. So I will not be surprised if the regulator and even if the government takes some steps in order to curb trading in the market. And as you know, stock market is the toughest place to make some easy money. So I will not be surprised if the government takes some moves, and the relentless rally that these brokers and and a lot of associated players are taking, they will take a breather in the shorter term. So my view is negative on all of those companies, because the regulator and the government is really concerned with the stupendous rise in the F&O trading in India.
Yeah, well, multiple newspaper reports as well, and multiple theories about what could come in order to do this as well. But remember, I must tell you, viewers, ahead of every budget, there will be, and everybody tries in their own earnest way to try and get the best possible news break around what could come in the budget. So keep in mind that some of these things will happen, some of these things may not happen. But yeah, stocks definitely react in the run-up to the budget as well on multiple such stories. Let's wait and watch if today...
I just want to add to that. You're absolutely right that the pre-budget stories, they could completely be kite flying. But Niraj, the fact is that you've had Shaktikanta Das, you've had SEBI, and you have the finance minister factually coming out and saying that they're worried about what they're seeing.
Yeah.
So that is a red flag, one way or the other, whether anything comes in the budget or not.
Most certainly, yeah, but that's the point, that it may or it may not, but in the run-up to the budget, some of these stocks will react, and let's wait and watch. Remember, today's reaction is of course completely different, and the reason is completely different. Presumably, this is all happening because of the strictures on JM Financial and maybe a collateral damage to some of the others. But brokerage notes, the key ones, my colleague Harsh Johnson with the key note to focus on this morning. Harsh, good morning.
Good morning, Niraj. Very interesting note coming in from Nuvama. They've initiated coverage on Bikaji Foods. Now, this is, of course, largely a savory snack business. And just in terms of a context, Rajasthan, Assam, Bihar, they have very, very strong market share, especially in Rajasthan and Assam. 45% market share in Rajasthan, 57% market share in Assam, and 26% in Bihar. Now, these three states are around 18% of the overall industry. So, just geographic expansion is what Nuvama, in its first set of notes, has focused on. Imagine when they start tapping into the other geographies. Where are they going now? Into the untapped regions: UP, Punjab, Haryana, Delhi, Karnataka, and Telangana. These are some of the other pockets that they are going to start to tap. Now, growth in terms of FY20 to 24, 21%. These 6 states are around 32% of the country in terms of market share. So going from 18 to 32, or adding another incremental 32 in terms of competing in those states, and therefore the market share likely to start to go up, especially in this particular pocket. this should of course drive revenue growth going forward as well. Now, just in terms of margins, they are penciling in, or Nuvama's penciling in around a 21% CAGR in terms of margin. They're expecting roughly a 15% margin by FY27, and therefore they also believe that margin tailwind is available for the company. In terms of the valuation, 55 times FY27 EPS is how they value the company. 885 is the target price, 23% upside from here, so slightly on the expensive side, but given the kind of projections they are making and the tailwind that they are seeing in the business, looks to be a very interesting one.
Okay, 2.5% higher. Well, not just Amit ji with loves Bikaji, a lot of others do. My co-anchor Tamanna does. I wonder if Aditya Shah does that too. Aditya, do you find merit in the argument that is being put out on Bikaji Foods?
Niraj, I don't track the stock, so would not like to comment on this one.
Fair call. Okay. But the stock is done decently. Kush, is there a trading play here, Bikaji?
There is. The stock's actually done rather well, and we're seeing some sort of profit booking, but that is actually part of the course. So any dip perhaps that you get towards 720 should be a good entry point. But other than that, whoever's got it should not look to book out too early. The stock's got good momentum, and you could continue to hold on to this one from a near-term perspective. 775 and 795 other levels to look at on the upside.
Okay, bless you. That's for Tamanna. As the pre-open rates have settled, C Info is up 5%. So, that Goldman note has had an impact. And I think if you speak of Goldman notes, then I think today they have gone ahead and upgraded Polycab as well as KEI, the target prices. So not necessarily a rating upgrade, but the target prices on both Polycab and KEI have been up by Goldman. Their simple fundized copper prices have gone up. Revenues will move up and therefore EPS turns up. And by the way, it's not factually incorrect. That is actually what happens in businesses like these as well. Aditya, any coverage on these wiring names? And do you like a Polycab or a KEI or any other?
So the FMEG sector, as it is known, is doing extremely well and will continue to do extremely well as the government continues to invest in the infrastructure side of it. And as we know, government's push is continuing to be on the infrastructure side of it. I am positive on the sector per se, but valuations across all of these companies are really very expensive. Say a Polycab or a Havells, even for that matter, is really very expensive. So I would advise investors to add these stocks only on some correction. My top pick will continue to be KEI Industries. And then you need to watch out for what happens on Polycab. There was some taxation issues that had gone on to Polycab. Onto Polycab Industries, and I will want to closely watch this stock, but entirely positive on this sector person.
So Polycab, KEI though, has after 2 days of pain may see a bit of a pullback yesterday. Remember, they had problems at 2 of their plants, so that was one of the reasons that you were seeing this hit. I want to see what's happening to all your defense plays. Garden Reach is down about 1.5%, but an HAL, Paras, are they also seeing profit booking after a run-up? HAL still up in the green, at least at the end of the pre-open session, but not too much movement over there. Aditya, is this something that you'd let alone for a bit? And could we be seeing another round of buying ahead of the budget?
Tamanna, defense is a long-term play now. The indigenization of defense is a play that is going to play out for the next 5, 7, 10 years. However, we've seen that, for example, in case of HAL, where the government only thought of giving 145 light combat helicopters to HAL, and the stock rallied. So this delivery of these helicopters will be over a period of next 10 to 15 years and not suddenly, and the revenues will come over a period of time. So in my opinion, all of these stocks have run up massively. The revenues will come over a period of next 5, 7, 10 years. So my opinion is that the valuations are extremely aggressive. If you have these stocks, you can continue to hold on to these stocks, but a fresh entry on any of these defense counters is not warranted per se. But defense as a sector is a very good sector to be in right now at this stage with the fillip that the government is trying to give in. So wait for a breather. These stocks will give some correction here or there, and then try to add some companies in a staggered way, because valuations across these sectors are in a bubble zone, in my opinion.
I want to revisit IT stocks and look at where the Nifty IT is poised before the open session, the market opening, and after the pre-open session, 1.5% up. LTI Mindtree doing well, Coforge, Infosys, Wipro, HCL Tech, all of those stocks in focus. Kush, since you spoke about IT from a shorts perspective, what would be your advice right now?
Well, again, if there is an opportunity to go short, Wipro is still, the candidate for me. There is still, some room, left before the stock actually crosses that 500 mark. That could act as a bit of a resistance. So, in fact, this gap up might provide an opportunity to make some intraday short positions. HCL Tech also we spoke of, 1480, 1500 again, a resistance zone for this one. So, with 1480 as a stop loss, if you want, you could consider a short trade on HCL Tech. But as I said, these are more intraday plays. Not very constructive from a long perspective, but for an intraday perspective, if someone does want to take a short position, you can consider both HCL Tech and Wipro.
Okay. Kush, in which case, 20 seconds, Kush, your top stock after the pre-open rates have settled, your top trade today, this morning.
Bharat Forge, 1840 and 1870 being the target, and about 1780 should be your stop loss.
Okay, so 1780, about a 24 rupee stop loss and a target of 1860, I heard Kush say, 1860 or 1880. Seems to be an intraday or a short-term trade, so bear that in mind. But auto ancillaries, and I'm classifying Bharat Forge as an auto ancillary, though it's much more than that. But yeah, auto ancillaries are on a bit of a roll. Watch out for this one. Actually, Ramakrishna Forgings too has had a great run. But let's first talk about how markets have opened this Friday morning. About 0.25% higher, not bad. Just about there actually. Now kind of cooling off to flattening out. Banks, let's pull up banks and see if they are continuing the move. Okay, lying flat today. Well, IT is compensating for that. I think the index may be up 1.6% higher for Nifty IT. I must repeat, Accenture was up, yes, but for completely different reasons. So bear that in mind. But for now, IT seems to be doing okay. Let's see if Indian IT majors can actually come out with generative AI deals in the commentary and in the numbers when they come out with the results in July. I think it will be very, very important. Bring up the heat map actually, because let's focus on IT for a bit. Then we'll focus on mid caps and small caps. Look at that. The top 6 names are IT names. And then there is an Adani Port, which has also done really well. But Nifty IT is on a roll today. We were wondering whether the opposite will happen. If IT sulks, will banking, which has done so well, make up for it? Banks are taking a bit of a breather today. Actually, not even breather really, because ICICI Bank is still in the green. But maybe it's an index not as strong as it has been for the last few days. But IT is perking up even more. Commodities a little cool off, and M&M for the last 2 days a bit of a cool off. But I want to pull up the intraday of the Nifty IT or just the tick of the Nifty IT once again, because the stocks are strengthening as we speak. LTI Mindtree is now up 3%. Can we get Nifty IT once again on the screen? Tech Mahindra up 2.5%. HCL Tech up 2%. There's a big move that is happening in IT stocks. Just before I hand it over to Tamanna, 2% higher now, 731 and counting. Boy, on a day when the Sensex and the Nifty are flat, it is the IT index which is starting off very, very strongly. Let's see if this lasts, Tamanna.
Yeah, absolutely fantastic. So Accenture maybe heralding something more positive than is initially visible, but Nifty IT definitely the flavor this morning. We look at what the mid cap and small cap is also doing, and on the broader markets, you've seen the kind of mood that has shown itself all through the week. So about 0.5% up on the Nifty mid cap 150. Small cap index also not moving too largely. It's about specific stocks and pockets. And let's start with some of those on our radar. CE Info Systems we talked about. After that one positive Goldman Sachs note, you have seen CE Info Systems again with a great day. Remember, 2,800 was the target price that Goldman Sachs talked about. In the last 2 days, CE Info Systems has rushed towards it. It is the company also known as MapMy India, more popularly, has been doing very well. So is Endurance. If I was looking at this entire space of Auto Ank as well, or companies which provide technology to cars. Let me just put it as simply as that. Endurance is one of them. Citi is excited about it. They met the management in Singapore, in fact, so about 2% up on Endurance. Fertilizer stocks is something that we have to review. It's been the flavor. We've been talking about it all day. Apart from a fact, everything else is seeing a pullback, and Chambal Fertilizers down, RCF down. Fact is the only one which is soaring at this point, but fertilizer stocks in focus. Remember, Chambal also had a block deal, so that could be some of the reasons that you are seeing that pain point. BKG is the other one we've been talking about. Nuvama is excited about it. They have a buy rating and an 885 rupee target. The stock at 738 right now, 2.5% up. JM Financials is the other one, and I also want to pull up Motilal Oswal and Anand Rathi if we can. So JM Financials has its own, pain point going on with SEBI. They have seen restrictions which will now continue till March 2025. But across that capital market play, you're seeing some kind of pressure coming in because of the expectations perhaps that the government will come down on the volumes that we've seen in derivatives, and perhaps more than anything else we'll be looking at restricting retail investors from going overboard in this section. Let me put it that way. So 3% down on Motilal Oswal this morning. But those are some of the factors. I think the IT buzz, Niraj, is across the board. Look at a Sonata, look at any of those companies. Anything IT is seeing a lot of excitement today.
It's just amazing what's happening in IT in the session today, and it's not just restricted to large caps, as I said. I think Tamanna marked CE info, but I just want to do it again just because the stock is doing so well. Up 9% yet again in the session today. 2 days on a trot now. 20% up yesterday, 9% up today. CE info system and that Goldman note has really set the stage on fire. The management, of course, spoke to us and spoke about the optimism there too. So keep an eye out for that. And aside of that, just a word on the profit booking that we see in the fertilizer names today. I'm so glad Kushpura pointed out that it's so risky to get into these stocks at the current levels because everything out there seems to have come off. Last stock before I get to our experts, Aster DM. Clean out trade has happened. Remember, I mentioned it on the trade setup that in Aster DM, while it was a 7% discount, there was an option to upsize the trade to 5 crore shares. And 10% of equity. I think that whole equity trade has happened, as a result of which Aster is in the green, because now the clean out trade has happened and the overhang of supply is not there. Doesn't make it a stock that is necessarily a buy. Maybe Aditya tracks it, maybe we'll ask him. But the limited point is the overhang of supply is out of the way for Aster DM. So lots of initial conversations. I'll start off with the larger pack where there is more interest. We'll also talk about Aster though. But Kush, very quickly, if you are long into fertilizers, I know you mentioned that you won't go long, but if somebody was long into fertilizers the last 3-4 days, would you recommend booking profits? The stocks are off about 2-3% already.
Absolutely, Niraj. And the word is, the idea is that, despite the kind of profit booking that we are seeing from the open, the stocks are still in the green. At least some of the names are. So depending on your position, not a bad idea to take the money home. There's been a stellar run, you'll still be in the money.
Aditya, small stock, I don't know if you track it, but have you looked at Aster DM fundamentally? A clean out trade has happened. Aditya, that's for you. You're on mute, I think, Aditya. Aditya, I can't hear you. I think you're on mute. Okay, I think we've lost the audio. We'll get back to Aditya in just moments from now. But Aster DM, watch out, bobbing between the red and the green. I wonder if technically it is showing any kind of indications, Kush?
No, so Niraj, I like what you said. Despite the fact that it's recovered, the early dip, there isn't really an indication that you have to go out and buy this one. It's still struggling around the 20-day moving average, so you wouldn't really see any kind of momentum building onto this one. So wait for a move above 365, 370. Perhaps that's when the momentum will kick in, and you could consider buying. At the moment, just put it on a wait and watch list.
I just want to point out what's happening in your mid-sized and smaller-sized IT companies as well. Let's look at Happiest Minds. Look at Sonata Soft. Look at Mastech. Look at LTI Mindtree. All of them having a great run up today. I don't know if you're seeing L&T Tech as well. Are you seeing a short-term trade here on the positive side, Kush, or you're still staying away from IT after what we've seen in the last 20 minutes or so?
No, I would still stay away. My view is a little cautious on these. So any kind of rise is perhaps a profit booking opportunity for me in the near term. So
Yeah.
I will perhaps sit on the sidelines on on some of these IT names.
Okay, Aditya, I just want to check if you have your audio back on. Can you hear us?
Yes, I can hear you. Can you hear me now?
Yes, I can. Fantastic. Just wanted to take that IT question to you because look at a Zensar Tech, look at a Persistent, everything, all things IT doing well today. How would you play this?
So I will be holding on to my IT names. As I said to you, 25 and 26 will be the year when IT will start to do really well. So right now, since there is no correction, there's nothing to do on the IT names. Hold on to the stocks that you have got. I would be particularly attracted towards something like an HCL Tech in the larger IT space, and something like a LTIM or an NTTS or something like a KPIT Tech within the mid cap.
Would you accumulate right now if a viewer doesn't have positions in IT because it's been so negative on IT? You're saying 25, 26 is the year of IT. Would you buy anything right now?
So as I said, these 3-4 names are the ones where I will do some staggered buying. Also, I will have a keen interest on what is happening in the US and the US Fed commentary, because that could spark off the next leg of rally for all of these players. If the US Fed comes and decreases the interest rates far more than expected in the next year, then that could be the next fillip for the run. So LTIM, LTTS, KPIT, for that matter, Tata LXC, these are the 4-5 stocks within the mid cap space. In the large cap space, I would look at a HCL Tech, then a TCS, and then a Infosys.
Fertilizers are seeing profit booking all except fact. That's the only one that's okay. So, important to keep that in mind. I want to see what's happening with your insurance players as well, which we spoke about earlier. SBI Life, HDFC, LIC, are they responding at all to that IRDAI stricture? And not really right now. HDFC Life down in the red, but the rest doing okay. Aditya, on financials, and we've been having this conversation for the last couple of days where insurance might be the next pocket in the larger BFSI basket that one must look at. Do you share that view?
So I'm positive life insurers per se. Even though IRDAI has hiked up the surrender value, and in the first 5 years, the insurers will have to provide a special surrender value. This will only lead to curbing of mis-selling. In the shorter term, these insurers could see a slowdown in growth in terms of the products other than the protection products. However, this will force all of the insurers to push protection products such as the term plan, such as the annuity plans. So in my opinion, I am positive on the life insurers, something like an HDFC Life, which has been very aggressive on the term plan growth. There I am positive on. I'm also positive on somebody like an LIC, where improvement in margins are a key monitorable. And if they are able to come back to 25% VNB, the stock would get re-rated from here on. So I'm really positive on the life insurers. However, you will have to give them time of at least 1 or 2 years before they start to give in some real return.
Okay, what else? So Tamanna spotted the brokerages, the way they've come off. RCF has come off, so those are two. And IT on the upside. That's essentially the lay of the land in the session today. Some real estate names, of course, continue to do well. Raymond, I think, has got about a 4.5% uptick as well in the session today. So that's one stock. But must say, it's a relatively muted day today in terms of gainers relative to what we see usually. Expensive names still continue to do well. Astral is up about 3% at 2275. So watch out for that one too. You spoke about FMEG, Aditya. Talk about building materials, pipe companies, etc. Tell us if you like the likes of Astral, Supreme, or some of the others.
So the real estate as a theme has picked up, and I'm really positive on the real estate sector. We've seen demand being really very strong for all the real estate developers, and that it will be so over a period of next 3 to 5 years. Strong developers will do extremely well. And connected to this, the real estate ancillaries, for example, the paints, for example, the pipes, for example, the tile makers, I'm really positive on all of these companies. For example, somebody like a Kajaria Ceramics, for example, somebody like a Serra Sanitary Ware. All of these companies will start to do really well over the period of next 3 to 5 years. You have to be really very careful on what type of companies that you play on. The balance sheet should be really very good, and the product portfolio should also be really very strong. So my perspective is I'm positive, particularly on Astral. Astral, in my opinion, is a very long-term play. The stock is really very, very expensive. However, the quality of the company is really very good. In my opinion, if somebody wants to add the stock, you need to stagger out your investments because the valuations are extremely expensive in this.
All right, so that's the take on Astral. What's happening? IT is up and about and having a fantastic day after a long time. Fertilizer stocks seeing profit booking. So are defense stocks, by the way. All your defense favorites are seeing a bit of pressure today. Capital market stocks also down. CE Infosystems beating all trends and continues to have a very, very good morning. We're taking a very short break. I want to thank Aditya and Kush for joining us on this leg of the show. But on the other side, we'll be joined live by Go India Stocks' Rakesh Arora and Manan Shah of MICL Group from the GIA Promoters Forum. We're going to be talking about the infra sector and a lot more. Stay tuned.
Back with India Market Open right here on NDTV Profit. Well, real estate was a sector that has been abuzz now for a number of quarters, if you will, and was abuzz yesterday too. So, as we are covering the GIA Promoters Forum 2024, we thought it's best to get in the founder of the forum, Rakesh Arora, founder of Go India Advisors, of course, or Go India Stocks, and Manan Shah, MD of MICL Group, to discuss about the interest around real estate and what is the kind of execution outlay and the kind of numbers that the companies can clock in after clocking in very heady numbers over the last 2 or 3 years. Gentlemen, thanks so much for joining in. And Rakesh, a bit about the conference, of course, but also the real estate flavor, because I see there is prominent real estate interest in your forum or conference around this sector.
So, Niraj, thank you for inviting us on this show. So we have around 21 promoters who are participating at this forum. And just to give you a comparison, last year we had like 160 participants. This year it is 550. So that is the kind of change in sentiment towards the market. Obviously, there's a lot of wealth effect, and a lot of reforms have happened in the real estate sector. That real estate sector, after being in kind of consolidation mode for 10 years, is now actually coming up in a big way. Fortunately, the affordability still remains extremely high. And that's why most of the companies are more to launch new products. The last 2 years, despite the healthy demand that we have seen, inventories have actually gone down. So there is need for new supply to come in, and I think Manan will tell further on this. But real estate sector is definitely looking really good, and with interest rate cut possibly in offing later in the year, maybe things will look even better.
Okay. Manan, fill us in on this. You guys have traveled some distance in terms of execution over the last 24 to 36 months. Where does Man Infra go from here?
So basically, the Mumbai journey has been really good for us. So we've procured a lot more projects. We've got more than 6 million square feet of a pipeline coming up, and we've been focusing on the ultra luxury sector in the past 1 year. So we've procured a lot of projects in and around the city, naming from BKC, Pali Hill, Tardev, Marine Lines, Juhu. We are about to complete one more project, and we are also coming up at Ville Parle. So the company's journey towards the ultra luxury portfolio is growing very strong. We've just launched another larger project at Ghatkopar East, where we've already sold more than 300 crores of stock. Also, overall, there's a very positive environment for the company, where the customers have been flowing in, the bookings have been constantly happening, and we see this momentum continuing because there's a positive approach towards real estate after a long time, and people have been appreciating the quality standard products that we've been doing. So yeah, things looks good.
Manan, do you reckon that there is enough appetite for the quantum of construction that is happening? Let's say in your case, you can talk about MMR. We'll ask the same question to Rakesh, of course, for Pan India as well. But for MMR and other areas that you might be present in, part one of my question is that actually. Let's first focus on that. Then we'll come to the other aspects.
So I would say people have actually got a very brand conscious now, where people have been wanting to buy something which suits their lifestyle, suits their needs, and people are wanting to buy apartments which they actually wanted long back. So now people have been wanting to shell out slightly more out of their pocket as well, where they're going and opting for larger spaces, because post-COVID, there's a lot of mentality and thought process which has changed, which is in a positive side, where people are looking at not just real estate as a potential investment, but it's also an essential. And people have realized that owning a space in any of these tough times, if you had a home, it's never been a problematic situation for those then compared to the basic rental people. So we've always been getting these testimonials from customers, in fact, that they were really appreciate branded construction developers, which, for example, like us, where we've been delivering projects before time. So I feel for people who've been delivering, for people who've been doing their work constantly with some good quality job, there would definitely be an appetite for those.
Manan, one question to you and then to Rakesh. Rakesh, I'll of course ask him about the multiple companies out there too, but to you. Now, because there is no other way to figure out except for pre-sales or reported sales, Manan, I'm not asking you for the next 12 months. I'm asking you from where you are right now, either in terms of a metric of area under development sold or actually in terms of revenues? Because in your case, you straddle from mid-income housing to premium as well. So maybe square footage might not do justice. Where is it that you will be 3 years out from where you are right now?
See, we've already secured a pipeline which is more than 15,000 crore as of now in our portfolio. And definitely we're looking out for more and more projects because we've been delivering projects every year. So 3 years from now, I see a comfortable pipeline of more than 25,000 crores in our portfolio coming up. And of course, a lot of it would be ongoing right now as well, which is a large scale project, so that we would be executing in the next 5 to 6 years of time. And even as of now, if I say for this current year also, the targeted sales is nearly 4,000 crores. So if you compare it to the last year, that's nearly the 4x of the number that we've targeted this year, and which we've already secured in terms of getting the project. Now the launches are due in the next upcoming quarters. By March, we would be launching nearly around 5 to 6 new projects out of our portfolio. So yes, the next 3 years down the line, I think 25,000 crore would be a comfortable number to state.
So that's the story as far as One Infra is concerned. But good morning, gentlemen. Tamanna here as well. Rakesh, since you have the sort of visibility on the space, and especially some of the smaller players through your conference as well, I'm trying to get a sense that for buyers who moved towards branded larger players post-COVID, is that tide turning? And the focus may be on quality projects, but is it also on the bigger brand names?
That is true. The demand for luxury and ultra luxury has been outpacing, the other categories in a big way. And this is a phenomena which is seen not just in Mumbai, but also in the other regions. So I think, that is the segment which is likely to do very well. Obviously, there is affordable housing, which is now getting a big push from the new government. And so hopefully that segment will also start to kick in. But, the preference is definitely for larger size project with a lot of lifestyle amenities, because work from home is getting a little bit ingrained and people need larger spaces and they want, more out of their houses. So I think this trend is a longer term trend. It's not really a fad. It's not going away anytime soon.
But what about the concentration? Is it still continuing in MMR, NCR? Are you seeing that? Because, that's the problem largely with Indian real estate, right? The growth is coming only from the top 8 markets. Are you seeing that expanding when you're talking to people there? Are they seeing it expanding?
So, see, this big shift is happening across various businesses where things are moving from unorganized to organized sector. And this is more evident in larger metros because you have big players like, Man Infra, etc. And which is visible. In smaller cities also this change is going to pick up, and we are seeing a lot of larger players now saying that they have some plans for tier 2 and tier 3 cities. So you will see this trend penetrating into the, across India. So metros is just a start. I think there's a whole country to be, catered to later on.
Interested to know your view on that, Manan, as well, because you do work on both ends of the spectrum. Do you think that the time of affordable housing is also coming, or is all about luxury, ultra luxury that continues as far as the business perspective goes?
See, for the past 2 years, I see the HNI people have made much better revenues in terms of everybody's business have been growing. So yes, definitely the ultra luxury is picked up, but to follow affordable housing is also a very key element, which is part of our portfolio as well. I see a lot of the salaried people which have been making much better, bonuses also in the past 2 years. I've seen that sector also picking up well, and eventually affordable housing is kind of the backbone also for our country, because the majority population comes in from that side, which contributes to the real estate sector. So it has to pick up, because both the ends, the ultra luxury would not just only sustain in the industry. We will have to match both, and I'm seeing people buying. I'll give you an example of our Mira Bhayandar project. Like last year we had launched that particular project. We've sold nearly around 300 plus of units in that as well. And this year we've targeted another 200 units in that particular project, and things have been moving very smoothly. We are still seeing continuous movement at that particular project as well. So I do see affordable housing also picking up. Yes, the pace is slightly slower compared to the ultra luxury.
Okay. Rakesh, one final question to you. And like I started off asking, that you've multiple, the flavor of real estate is evident in your forum this year. Now, you obviously can't talk about Man Infra. He's sitting with you. But just tell us about the kind of growth that you expect, maybe even Man or maybe some of the companies to clock in over 5 years. You are exempted from talking about Man because Manan is sitting right next to you.
No, obviously, so Man Infra is a very, excellent business model, asset light, high ROE, and, it's a cash-rich company. The other business models that we are seeing within our clients are, companies with large land banks fully paid up and now in monetization stage. They are monetizing it through various measures, like one of our company, Niraj, is doing data centers from its commercial space. We have got a Ganesh Housing, which is doing both an SEZ, which is a combination of residential and commercial. So those companies are also benefiting, because the land bank value has gone up so much, and they have already paid for it. It's in the price. So real estate, I think, is in good times, and as I was mentioning, that it's a slightly longer term trend because real estate cycle normally lasts at least a decade. So, I won't be surprised that, next 5-6 years we have a, continuing boom.
This last point, Manan, I just want to follow up from the point you made about affordable housing. Do you see it having a larger share in sales going forward? Do you see it inching up, or will the push still be towards luxury for you?
See, I believe every person would eventually want to have a luxury house, right? So the sentiments have always moved from affordable towards luxury, and especially post 2020, the trend we have seen, like the sizes of the houses of an average 2 BHK, if you see in Mumbai, were at 500 to 600 square feet. Now people are wanting to opt for 800 square feet and all. So I feel affordable sector is really very dynamic, I would say. It keeps on fluctuating and changing depending on the economics, how the country is performed. So I would say it would be slightly more volatile and more flexible. But yes, everybody would always aspire to own a luxury home. So the sentiments will move towards the larger houses for sure.
Yeah. Everyone will aspire to own a luxury home. Whether they can or not is always the question. But great speaking with both of you today. Good luck with the rest of the conference. We'll take a very short break right here on the show. But on the other side, we're talking in a sense about affordability as well. Goldman Sachs' India economist Shantanu Sen Gupta speaks with us. It's an exclusive conversation. We're talking about their report, which tracks the changing contours of Indian household savings. All of that and more on the other side of the break. Welcome. We're speaking now with Shantanu Sengupta, the India economist at Goldman Sachs, who's put out and co-authored a very interesting report on the changing contours of Indian household savings. Shantanu, very good morning and great to have you with us on NDTV Profit. What struck me in the report is that India's gross savings are still higher than the global average. One would assume that the drawdown would have increased in the years post-COVID. And the overall concerns and narrative seems to be that Indian households are not saving as much as they used to. So let me start with a qualitative view from you more than anything else. Do you think, in relative terms, the state of Indian household savings is not something to be concerned about?
So the way we look at savings overall for the economy is that if there was a savings problem, it would have manifested in the current account deficit because the net savings in the economy with investments will have to equal to what is the government doing in terms of its savings, which is the fiscal deficit, and then reflect finally in the current account deficit. The current account is in the region of 1 to 1.5% of GDP. So on an aggregate perspective, we don't think there's a problem. The problem with household savings is that it's not like the gross savings has gone down, but on a net basis, you had declined because the households were taking on a lot of leverage. The RBI has come in already from late last year and started tightening norms around unsecured lending, especially, which means that that will correct itself over time. And then if you see the mix of overall savings in the economy, we think it looks fine. From an aggregate perspective, if there's no problem in the current account, I would not worry too much about what is happening with just the pure household savings from a macro point of view.
Yeah, okay, I get that point, but let's come to that granular perspective. And you contextualized it well in terms of concerns that the Reserve Bank has had. I don't know. I'm not too sure how much is going to impact spending habits. You can squeeze out all the buy now, pay later schemes that you want. But is that now a shifting trend as far as household savings go? One, as your report mentions, that you're moving those savings away from things like real estate, more to capital markets as well, more to retirement-focused savings, and on the other, the overall expenditure is increasing.
Yeah, so that's the big shift that we saw in the savings behavior of households, which means that you're moving out of the traditional bank-related savings towards the non-bank savings. Now, in non-bank savings, what is very well known is the capital markets, mutual funds, more investment into shares and debentures and so on. But what we found was that, retirement savings or insurance savings, so both into NPS, pension, PPF, all kind of small savings and insurance also constituted a large part of this shift away from household savings from bank assets to non-bank assets. Now, if you compare this across the world, you will find that the developed markets are anywhere in the region of 20 to 30% of bank assets, and the rest of them are in non-bank assets. Even if you look at the eastern countries like Korea, Taiwan, they would be in the region of 40 to 50%, 45% maybe of bank assets and the rest in non-bank assets. India right now is at about 60-40, which means for us that there's a long runway still to go for this financialization of savings towards non-banks. So we think that as the demographics also in India plays out and you go through this development cycle, you will have a lot of savings keep on anchoring insurance, pension, and retirement savings. There are important implications of that, which I can discuss later.
Let's come to those important implications. But just before that, Shantanu, when you're talking about the move of household savings towards non-bank assets, retirement funds, insurance, etc., there's also a capital market move there. And I was just wondering if there is more sort of insight that you can add to something that we've been observing. More and more SIPs every month, mutual funds, etc. Do you see that as a trend now growing at the same pace, or have we hit sort of a peak there?
No, we actually think that trend continues, into mutual fund AUMs. So if you add up all of mutual fund, insurance, pension, retirement, etc., that has been growing at about 15% CAGR over the last 8 years or so. Compare that with about 9.5% CAGR growth that you've seen in bank assets. And we think that that will continue. That trend obviously is playing out in what you're seeing in the equity markets. You've seen the domestic bid being pretty strong, even as you've had some FII flows, which is what has also held up the index fairly well.
Let's come to the implications, and you've put that out in your report, but please lay it out for us here, of this kind of shift in household savings away towards non-bank assets. What does it also mean, for example, for traditional means like real estate, gold?
So the two important implications that we found was that if you look at pension and insurance companies, they are right now buying the long end of the government bond curves. And the government and the state governments are both happier to issue in the long duration. Now, if you look at the asset liability mix of these kind of players, they're happy to hold these long bonds as they're getting the supply from the government. That has resulted in a flat government bond yield curve, which we expect to persist for now. But as you roll this forward, you think that if you now bake in that the government's fiscal will consolidate, that is you move from about 5.6% of GDP fiscal deficit this year target to about 4.5% of GDP in 2 years' time, then you're having lesser issuances while you're having this savings continue to grow. If there is no further issuance from either the quasi-government space or the corporate bond market, we think that the yield curve will eventually invert, which means that it's important that the quasi-government corporate bond space, PPP space, comes out and continues with the infrastructure asset creation. The infrastructure asset creation will be funding this kind of a long duration asset. It can't be the typical shorter end funded kind of a capex cycle, but it has to be the long duration infrastructure assets that has to be funded through these kind of long duration savings. So those are the two main implications that we see out of this, that one, a flat government bond yield curve, and eventually issuances coming from either quasi-government, corporate bonds, PPP, hybrids, to continue with the infrastructure asset creation, which will channelize these long-term savings.
All right. So those both, of course, positive implications from a macro side and, the sort of government perspective of what they can do with those savings bumping up. But I'm also just trying to understand where all of this fits in with an interest rate cycle, which we are anticipating will turn. So Shantanu, first, your take on that. We're expecting a Fed rate cut maybe by December. What, in your view, do you think that the RBI will do? And the impact on savings, because remember, the move towards non-bank savings is happening despite basic interest rates being better than in the last few years.
So on the US cycle, our US economists continue to expect the first rate cut in September, although they are seeing that as optional, and then continue with one more in December. So we still see 1-2 rate cuts this year, and then followed by quarterly cuts in 2025. Look, our view is that core inflation for India bottoms out in this quarter, starts inching higher a little. But as you move into the next quarter, you'll have food inflation coming down because it is coming off a very high base in Q3 calendar year of last year. So you probably hit like sub 4% in the next quarter, and you inch higher as the base effects turn towards about 4 to 4.5% by the end of the year, which is when we think that the time is opportune for the RBI to cut. It's a toss-up between whether it can be in October or December meeting, but we think that in one of those two, the RBI will go ahead and ease by 25 basis points. The overall cycle of interest rate cuts in India, we think, is going to be rather shallow. We are only expecting 50 basis points of rate cuts in this cycle, 25 each in Q4 and Q1 of calendar year 24 and 25.
All right. Thank you for that, Shantanu. Great conversation with you. Shantanu Sengupta, there of Goldman Sachs, Chief India Economist, talking about his outlook on household savings, rate cuts and more. With that, it's a wrap on India Markets Open, but stay tuned. Talking Point coming up next.